Credit Suite Live. Today we are going to be talking to you about different options for financing your business. So today we're really going to jump in and take a deep dive on comparing the differences between debt and equity financing. This is a pretty big topic. It's got a lot of things that we're going to cover. We're going to go over all the different types of financing that's available for debt, some of the different options for equity, and then help you decide what's going to be the best option for you for funding your business as you move forward. So before we jump in, like always, if you're enjoying the live stream, getting a lot of value for it, make sure you share this. Use hashtag Business Credit Toolbox, and if you do that, you can go to creditsuite.com/toolbox and get access to 5 free tools for growing your business. It's awesome. It's our way of just saying thanks for sharing our live stream. Thanks for engaging with us. So if you're interested in that, like I said, go check it out at creditsuite.com/toolbox and share this with hashtag Business Credit Toolbox to get access to that. So let's jump in. Let's talk about the difference between debt and equity financing. When you're looking at financing for your business, there's really two major options that you want to consider. Now, a lot of times when you're looking at stuff, we have a tendency to come in and go, well, it's one type of loan or this type of loan. But really what we're breaking down today is showing you the difference between debt financing is and equity financing. And they're two completely different things. They're not, you're going to see as we're going through this, our first comment is equity lenders. That's we're going to jump into that and talk about what it takes for equity lending. So let's talk about it. So your two options that you have is debt financing and equity financing. And choosing the right option is going to depend on multiple factors that we're going to cover. But there are advantages and disadvantages to each of these options. One thing to keep in mind is as you move forward, there's always going to be pros, there's going to be cons one. And that's really what we're going to be doing today is laying these out side by side, let you see some of the options that are available and let you figure out, is this something that makes sense? Is equity lending something is a viable option for you, something that could actually really help you with financing your business? So let's start with the debt financing. Debt financing is when a company raises capital by borrowing money. Most of the time when you talk about business finance, debt financing is really what you're talking about. Debt financing can include business credit, business loans, anything where somebody's going to give you a chunk of money and you're going to repay it. Looks like Brilliant says, hey Keith, from Outbound Business Solutions LLC out of Tucson, Arizona. Man, Brilliant, I hope you are staying nice and cool out. You guys have been going through a massive heat wave. Steve Rivas says, what's up? What's up, Steve? Glad to see you on today. Always appreciate you when you jump on and comment with us. So let's dig a little bit deeper into debt financing. Debt financing, in return for a small business loan, individuals or institutions become creditors, meaning that you're going to somebody saying, hey, you're going to a bank or a lender saying, hey, I want to borrow some money. They give you the money, what it is. You set up repayment terms, and it's debt. They get a promise that the principal and the interest repayments, that the principal and interest will be repaid on the debt. So let's go into this. So as you're looking at your debt financing options, there's really the different options for debt financing depend on 3 different factors. And we talk about this a lot, but we're going to keep talking about it because it's really good. It's got a lot of great information. So the first one's going to be cash flow, meaning how much money does your company bring in? Cash flow plays a big impact on all your financing options. But specifically when you're looking at debt financing, cash flow has some caveats to it. The second one is credit, meaning your business credit or your personal credit will have an impact on your ability to get financing. And then collateral, if you've got assets that you can use to secure the loan. So let's jump into these a little bit more in depth. So as you're looking at debt financing, let's say you're coming to me and say, hey, Keith, got this great company. We're doing, $15,000, $20,000 a month in gross revenue. Things look good. We've got good, consistent cash flow. It's documented. It's verifiable. We can look at this and we can prove to a bank that we have this revenue coming in. So with cash flow options, cash flow is going to qualify you based off the revenue of the business. And so this is is options that we get this revenue financing. Merchant advance is another one. It's not all your cash flow, but with the merchant advance, what they're doing is looking at your merchant account going, okay, if you're running $20,000 a month through your merchant account, we'll loan you money based on the fact that we can prove your revenue through your merchant account, and we can see how much money is coming out of, or how much money the company is bringing in. Your third option that you have available is accounts receivable. So as you can see here, you've got 3 different options, which really kind of cover the whole gambit of everything that you'd be looking at. So your business revenue financing is just that. And a lot of times when you look at business revenue financing, it's going to jump into options like looking at your business checking account, business savings account. It's going to take cash, checks, merchant deposits, wire transfers, ACHs, anything going into the banking account is going to be covered by business revenue financing. Merchant advance is just that. This is really based off of merchants that you're running money through. And it doesn't necessarily have to be just a credit card merchant. It can be PayPal, it can be Stripe, which are technically merchants, but they're more utilized brand names of merchant accounts. But with merchant accounts, they're looking just off of the revenue that you're bringing in off of that merchant account. So if you're in a business that has, you're taking ACHs, you're taking wires, you're collecting checks from people and depositing them, a merchant advance may be okay option, but maybe not your strongest. Accounts receivables is if you're running a business that you're invoicing people on a consistent basis. So every month you're sending out invoices. They'll loan you money based on those receivables that you have available. So those are three options just for debt financing that just fall on cash flow. So let's jump into some of the other ones. Oh, looks like I duplicated a page there. So let's look at your collateral options. So with collateral, you've got a couple different options as well. With collateral debt financing, you're going to be securing your financing with the own collateral, which is why it's called collateral. Pretty simple, right? So these are going to include things like 401k funding. If you have a 401k that's non-active, that you would like to invest, there's some great programs out there that will actually let you roll over the entire amount of your 401k. And again, it has to be inactive, which means it's not at a company that you currently work with or that you're investing into, or like you're having part of your paycheck put into. But it may be like a 401k from an old job that you had that's sitting there. You can actually roll these over. It's called the 401k Robs program, and we've got a lot of videos on Facebook and all over the place about that as well. Some of the other options when you're looking at collateral is equipment financing, and that is just what it sounds like. It's financing equipment based off the value of the equipment, and it's not always just for new purchases. There are options called like the equipment leaseback program, where if you've got let's say you've got a tractor that's $50,000, you can actually do a leaseback program, which means that you're putting the equipment up collateral, and then you're actually collecting money, and then you're making payments back on it, just like you're leasing it again. But you've got that $50,000 in equity that's now in the business account that you can use for funding, use for different options. The other one's commercial real estate financing. Commercial real estate financing is secured by collateral. The real estate itself is collateral. And that's why a lot of times when you're looking at these options, I feel like I have one more. Okay, inventory financing. I did. So inventory financing, if you're running a retail shop, and you can have boxes of inventory, things that you purchase, things that you're using, that you can actually put as security for collateral for the business as well. The thing about the collateral options is that as you start looking into these options, they'll have the best rates, best fees. They're cheap, and the reason is because like a lender is going to look at it and go, if something happens to this business and they're not able to repay, there's a means of recourse, meaning that they're going to be able to come back, collect on it, to take possession of that property, whether it's the 401k, if it's stocks, bonds, mutual funds, or other ways that you can collateralize the loans, equipment. They can take those back and repay the loan, which is why the fees are normally a lot more reduced, and the rates are low. So Brilliant asks, so if a business owner owns older semi trucks, are they able to still qualify for collateral financing? Early 2000s. There's always options. If you've got equity there, if you've got financing there, or if you've got collateral there, even if they're older but they've still got value, that can very well be. And when it gets into some of the specifics like that, Brilliant, that's something that we'd have to have our team talk with you about, which we would be always more than happy to talk with you about. You can give us a call at 877-6487. Be more than happy to talk with you about your option. And then the last option, which I did cover but forgot to click on, is security-based lines of credit. So that's going to be your stocks, bonds, mutual funds. So if you're an investor and you've got stocks out there, you can actually use those stocks as collateral to get those lower rates and those better fees. And the thing, and listen, guys, the thing that I love about security-based lines of credit, if you're an investor, if you're somebody that you're out there, you've got money tied up inside of the stock market, you've got things that are producing a return, the security-based lines of credit are going to use the equity, the value of that to be able to secure a loan, but you're still going to earn on it, meaning that if you've got $1,000 invested in Microsoft, you put that up as collateral, that as that stock keeps rising, you're still making money on that. Plus, now you're making money off of loan with the business. I mean, it really turns into a win-win with it. So that's something to keep in mind. And one of the last one of the last things that the videos, and it may have been a while ago, I do a lot of content for us here. But one of the things that I always encourage business owners is, as you're growing, as you're getting profits, start looking at ways that you can be investing into collateral. Not only is it going to raise the value of your company, not only is it something that you can use, like what Brilliant was talking about, if you're a trucking company and you have all assets sitting there, but it's also something that you can use to secure financing later on. So it definitely has a lot of wins and a lot of value. Plus, it's just smart. Return. You're investing your money, your profits to make more money. So now let's look at some of the credit options. Credit options aren't near as robust because well, you'll see here in a little bit. To the credit options for debt financing is securing financing with personal credit, and it can also be business credit. So these are going to include business credit cards with those high limits. It's also going to be term loan. You can walk into a bank and go, look, I've got a 720 credit score. I'd like to get a business loan. Here's my credit. I'm willing to sign for it. And then you've got programs like the credit line hybrid, which you can get 4 to 5 times your highest credit limit. So, for example, you have a $10,000 credit card, you can get approved for up to $50,000 in credit lines just with your signature. The thing I like about the credit options is a lot of these, where they fall more under credit than lending. There's no documentation, meaning you're not going to have asset requirements, you're not going to have income requirements. It's much more flexible, but it does have a personal guarantee tied to it, which is why you're investing your credit. The last option is for debt financing is full doc options. So we just ran through these 3 C's, and if you go, hey Keith, I've got great cash flow, I've got great credit, and I've got collateral, that's awesome. Now with all 3 of those options available, now when you kind of unlock the really great loan we all want, which could be like SBA loans or traditional financing. When we're talking about traditional financing, that's going to get into things that we traditionally think of, especially in the older generation, that we grew up around local banks, handshake deals, things like that. And that's going to include like lines of credit, term loans, commercial real estate is really popular as you start getting into banks and you start looking at some of your more traditional lending options. So we just covered a lot of programs right there just under debt financing. So let's kind of break this down. Here's some of the pros of debt financing that I absolutely love. You have a lot of flexible options in your situation, meaning that no matter where you're at, if you've got some sort of financial strength with the business, whether it's your cash flow, your credit, your collateral, if you've got financial strength there's going to be some sort of option. Even if you have no strength at all, options with business credit, and there's still ways that you can get access to business credit without personal guarantees, which is a very powerful thing. The other side that I really like about debt financing is it lets you retain full ownership of the business. You're not giving up any equity staking. You're not bringing in any partners. It's still your business. You're able to use it as you want to use it. You're not bringing on any partners. It's a nice, clean deal for you. And the other thing about it is you can pay off the loans at any time without any further expenses, no recourse, meaning that when you're done with it, you're done with it. You call a loan, you pay it off in 3 or 4 months, and just move on with business, move on to your next growth phase. So these are some of the pros of debt financing. Let's talk about some of the cons of debt financing. What can be bad? Well, there's several things. Commercial lending is generally not subject to usury laws. Now, what are usury laws? Meaning interest rates and fees and payments it doesn't stop interest rates, fees, and payments from becoming exceptionally expensive. We've all heard the horror stories, especially once you get into some alternative lending, you start looking at like merchant advances, cash flow. If there's not other factors there, it could get very expensive very quickly, but it doesn't mean that it's always bad. One of the things when I was on the sales team with Credit Suite here, I had the opportunity to deal with the trucking company, and this guy called me up. He was an individual owner operator, and he had called me. He's like, "Man, I am stuck." I'm like, "Well, okay, what's your situation?" He's like, "No, I'm literally stuck at home. My truck broke down, and I can't go anywhere, and I can't move. I can't get my business on the road. I'm bleeding money just by sitting here." And he'd only been in business for about 6 months, so we didn't have like a super strong track record. He didn't have assets outside of the truck, but most of that was leveraged anyway. So he was really just coming as basically a startup, saying, "Look, I need this, or I lose everything." And we were able to have some of those business revenue financing options. They were a little bit more expensive, but it wasn't. But when he sat down and we looked at it, I was going over numbers. And I'm like, "Look, you're going to have about 15% is going to be about the charge of this." And he started looking at it. He's like, I'm going to be losing some money here, but it gives me the ability to get back on the road, to start making payments, to get this paid off, because without it, I don't have it. So keep that in mind. Sometimes business loans do get very expensive. There are higher fees, there are higher rates, but the difference of it is, as a consumer, the mentality of most consumers are, you're employed, you've got a salary, you know how much money is coming into your household every month. So as you're figuring out financing options and you're looking at credit options, it fits inside of what your salary is and how much money you're bringing in. As a business owner, you could have a marketing campaign that just goes viral, that just explodes on you just almost instantly. And now, instead of having a $10,000 a month, you've got a $50,000 a month or $100,000 a month. Business is more fun like that. I mean, that's why we do business, is that opportunity for those big windfalls and those chances to really get. So, as you're looking at some of these pros and cons, always keep that in mind as you're looking at how you're going to finance your business. How are you going to repay it? So let's talk about some of the other cons of debt financing. May require a personal guarantee. Most of the time it is. For one or more business principles, most of the time it is. Let's just be straight with that. When you ask for a bank for money, they're going to want a signature. And as much as we don't want, and this is, and I'm speaking specifically to small businesses. Now, as your company starts to grow, as you get into, the multiple millions, you start breaking into that 7-8 figure numbers. At that point, things change. The dynamic of what you're dealing with changes considerably. But just keep in mind that if you're asking for money, the banks are going to want you to sign and be personally liable. And as much as we don't want to do it, I had a banker tell me this once, and it always stuck with me, because I asked, I'm like, I was flipping a house, and I'm like, "Hey, can I do it just under the company name without personally signing for it?" And he looked at me and he said, "Look, if you're not willing to sign for your loan, I'm not either." I was like, "Okay, that's fair." He's like, "If you don't believe enough in what you're doing to put your name on it, why should I believe enough in what you're doing to put my name on it?" And it just changed my thinking about it. I'm like, okay, that completely makes sense. It answers all my questions. So next thing, when you're so with debt financing, it puts more personal assets on the line in the event of a default. So if you have a personal guarantee, just know that even if the business closes, it was a business debt, you're still going to be liable for it. You're still have to pay it back. All right, that covers the debt financing section. Let's jump into equity financing. This isn't quite as much information because it's just a little bit, not quite as many. But equity financing is a form of corporate finance where you borrow against or sell off a portion of your business. In exchange, you get business capital. So it'd be like somebody coming to me and going, hey, Keith, I see that you're buying houses or you're flipping houses or you've got this going on. I want to invest in you. I want 10% of what you're doing, meaning that as profit shares get paid out, I'm gonna collect 10%. You're still gonna keep 90%. That's essentially how equity financing works. You can use it to fuel growth of your business, buy equipment, expand, move offices, so much more. The thing that's nice about equity financing is a lot of times you don't have banks looking at you saying, we want you to spend money this way, but there are some trade-offs. To tell you the power of equity financing, large publicly traded businesses will sell shares on the New York Stock Exchange and NASDAQ. What they're doing with the New York Stock Exchange is equity financing. They're giving up shares of the business. They're giving up shares of how much profit that they're going to make in exchange for revenue to keep running the business. That's why the stock exchange is so valuable. That's why NASDAQ plays such a large role in the system. It's individuals, it's us as consumers investing into businesses and getting a return on their profit. Small businesses and privately held companies have several options as well. And these are going to include selling private shares, crowdfunding, angel investing, and venture capitalist investing. And so we're going to break down these 4 options for you and kind of dig in on these. So let's start with private shares. Private shares is a very straightforward process. Selling private shares can be a personal, professional relationship. It doesn't always have to be this super hyped up thing. It could be you've got a family member that's got some money that they're going to purchase a percentage of the business for a return. Now we're going to take a second here because a lot of times in our mind we think, okay, if it's a determined return, that means I'm gonna X percentage of profit. That's not always the case. When you're looking at equity financing, especially under selling private shares, you have the flexibility to create whatever deals that you want from your equity partners, meaning that you could say, look, I'm going to borrow $50,000 and instead of I'm going to pay you back $65,000, and that could be out of profit or it could be out of payment. But once I'm paid, I get access to my equity back. There are options like that. There are things that you can do. It's really up to your imagination and up to between you and your equity partner that you're bringing in. So there's a lot of flexibility there to put a deal together to really make it work. And so the returns can be payments or of profit, payments of profit sharing. So there's a lot of flexibility. There's some different flexibility and options there. Equity financing. So let's talk about crowdfunding. Crowdfunding is a little bit new. It's regulated by the SEC, which a lot of times when you talk about regulations and financing, especially in business, people kind of freak out. I love the fact that the SEC is in there simply because it brings a level of accountability. It makes it where when you're looking at these crowdfunding sources, you don't have to be afraid of having all these massive companies out there that aren't following rules, that are just out there to the business without any recourse. So this is it's going to be regulated by the SEC. And really the way crowdfunding works is it collects smaller investments from a larger number of private investors. So instead of one person coming to you and saying, hey, I'm going to give you $100,000, you may get 100 people saying, hey, I'm willing to invest $1,000. You still get to $100,000. Your payout's still the same. You're still giving up just as much equity, but instead of the risk being on one investor, it's spread out over 100 different investors. And really where the power of crowdfunding comes in. You take on no debt, but you will give up some of your ownership for the return. But the nice thing about crowdfunding is when you're jumping into crowdfunding, you're not going to have one partner who's going to look at it and go, hey, you need to do this. You need to make this decision. You need to look at this option. It's still 100%. You're still in charge. You're still running the company. You're still making things happen with it. And one common use of this form of raising equity capital is purchasing real estate. And I've seen this quite a bit. You start looking at actually that's what a REIT is. REIT, a real estate investment trust, is basically crowdfunding for real estate. So that's one common way where you've got a set project saying, okay, we've got $1 million. You get people to invest the down payments, and then once the property sells, they make a profit. Everyone gets paid. LLC closes, and you move on to the next one. The next option is angel investors. An angel investor, also known as private investor, seed investor, or angel funder, is a high net worth individual who provides financial backing for a small startup or entrepreneurs, typically in exchange for owner equity in the company. Some things about angel investors: they generally stay out of decisions, acting more like a silent partner. Norman asks, is this type of crowdfunding different than Kickstarter? No. Kickstarter is actually a great example of that, Norman. Great question. Kickstarter is actually the prime, probably our favorite example of this. And sorry, I didn't even think about putting some examples out there, but I can't even think of any off the top of my head outside of Kickstarter right now. But Norman, great question. That Kickstarter is exactly an example of that. So let's jump back into angel investors. They're going to stay out of the decision-making process, treating you more like acting more like a silent partner. There's a little government regulation applicable to angel investors. Now, as you start growing with angel investors, you start finding people who kind of do this as a full-time revenue stream. They can be accredited investors and be subject to regulations at that point. And I think that accreditation is something that you work yourself up to, that you get to at a certain point where they're going to require you to do that, just so they can make sure that things are working and acting the way they should be. All right, let's jump into venture capitalists. I'm going to fly through this. We put a lot of information on the venture capital, but venture capital is financing that investors provide to startup companies and small businesses that are believed to have long-term growth potential. Venture capitalists may want input over the direction of your company. When you're working with venture capitalists, these are companies that have millions, sometimes even billions of dollars to invest, but they're going to want to have some say in it. If they're going to invest a large amount of money for rapid growth, meaning that they're going to want to secure their investment. They're going to want to make sure that they're going to get a good return for it, and they're not going to take a loss. Businesses with access to venture capital can qualify for venture debt. And I just found this meeting. There's actually loans out there that you can get, so you can kind of blend the beauty of debt financing and equity financing. If you get a venture capitalist, you can actually get venture debt. Now, when I first saw this, I'm like, yeah, it seems a little redundant. If you're getting money for it, then you're getting debt. But if you think about it, the brilliance of it is that if you get $100,000 from venture capital and you're able to roll that over into venture debt, your $100,000 in venture capital stays as an asset within the company, meaning that your bottom line, your bank statements, your cash flow analysis, your balance sheets, all that are going to reflect that you've got that $100,000 in there. You use that money to pay off the venture debt, and now you've beefed up the value of the company, and it gives you some more flexibility. It gives you some more options for moving forward. Norman asks, is Shark Tank like venture capital or closer to something else? That's a great question, Norman. I would actually put Shark Tank a little closer to more of the angel investing side, simply because a lot of times with Shark Tank, you're dealing with one investor, meaning that you've got that one person, whether it's Damon or whoever it is, Mark, you've got that one person who's investing their money into your company, and then they may want to have some say in it, or they're going to give you some value with it. But Shark Tank a little more on the angel investor side, but it also kind of blends that line of venture capitalists where they want some input, and a lot of times that input that they're going to want to have is going to be more based on how much equity they have. But the other side of it is they're going to look for opportunities to be able to connect it to their networks, which we'll get into in just a second, which are the big value propositions of the equity financing. So getting a loan depends on the company's access to venture capital with the venture debt. So some tips about working with a venture capital firm. VC firms prefer disruptive ventures, including startups and younger businesses, And some examples of that, of SpaceX, DoorDash, Uber was another one that venture capital jumped in on. They're looking for things that are going to come outside of the market, outside of what's normally done, how things are normally handled, and look at it and go, you're going to disrupt the entire market with this and gain so much market share that you're going to have fast growth. And I think there's a couple of reasons. One, it just really financially makes sense for them to do that because bigger growth. But the other side of it is, as a venture capitalist firm, they're going to look at it and go, okay, you know what? If we're going to give you $1 million for startup, you're going to go into startup, you're going to go into growth mode, and you're also going to need, as you start expanding, you're going to need more money. Where now the venture capital firms like, look, we're going to basically be your bank as you're moving forward. But again, they're looking for those disruptive ones aren't real common. Ordinary businesses and established industries tend to not be on the VC's radar. So if you may have an amazing business, but it falls under a well-established industry. Venture capitalists a lot of times are not into that. They're looking for those big risk, big rewards, just big market shakeup type things. So let's talk about some of the pros of equity financing. I think a huge one is you're not taking on debt, so you don't have that monthly payment there, which as a startup or as a small growing business be just a life. It could be a big game changing event for you. As soon as you start taking on debt, now you've got payments that you have to manage. You pay no interest. There's no payment. So that's pretty straightforward. Accessibility to very different types of investors, which I absolutely love. And this is going to go back to what Norman was talking about earlier with it being Shark Tank. With Shark Tank, one of the things I love those episodes of Shark Tank where the investors will start fighting with each other over a deal. And the reason is because a lot of times, like I've seen Damon do this with people who own clothing companies. They'll go, look, you want to work with me. I'm offering you less, but you want to work with me because of the connections that I have. Meaning that when you're working with different investors, they're going to have these different networks. They're going to have all these different networks that they're plugged into. So if you're dealing with somebody who's a multi-millionaire, he's going to be able to start turning you on to other business owners in his network that you're going to be able to leverage. And it's going to expand your network of influence working with these different caliber of people, especially if you're a small startup and you're just kind of hitting the ground with Facebook posts and TikToks and Instagram Reels, and you're getting going. You get connected with a venture capitalist, you get an angel investor who's got a lot of those bigger connections like that. It's really going to open up your opportunities for networking, open up your opportunities to bring your product to market in a deeper, more stable way. And then it brings experience to the table from past successes. When you're dealing with venture capitalists, they're going to be able to see things in your business. They're going to be able to see, kind of predict what's happening in marketplaces, understanding what's going on, and you're going to have that experience on your side. You're going to have that experience on your side to be able to help you navigate through the process as you're going on, as you're moving forward. And I think that's something that you really want to keep in mind. It's almost like bringing on, giving up part of your equity for somebody who's already paved the way, for a coach to be there to make sure you have the funding, make sure you're using it, and keep things moving forward. Okay, Norman asks, which one is where I hear people say Series A's raise? So Norman, I think what you're talking about is that's actually an IPO. When you're looking at like initial public offerings, you're looking at publicly traded companies. That gets more into that side where they're actually offering portions of their stocks in exchange for the investment or the revenue. And they may present this, it depends on publicly traded, but that starts getting into the multi-million dollars investment side of it. Yeah, and all of them are going to follow a lot of that same terminology. So let's talk about some more of the pros of the equity financing. With crowdfunding, none of your equity investors are very large, which is nice. If you retain over 50% ownership, they're unlikely to be able to band together enough to kick you off the board of directors, which is nice. And actually, we're going to get into some of the cons here. Some of the cons are you are investing the equity of your business when you're doing equity financing, meaning that if you only have a set amount of equity in the business. So if it's 100%. So if you give up 10%, now you only own 90%, which means that when it comes to profit payouts, you've now lost 10% of that profit. The flip side of that is, if we're being very honest, would you have gotten, it's easier. I would rather have a smaller piece of a really big pie than all of no pie. And so if you've got an opportunity to really take your business to that level, bring in an equity partner that can get you to that place where you're instantly turning around profit and you're making those big returns, it's a small trade-off. You have to prove that you have something that has growth potential. You can't about something how keep wasting my business. You've got to show unique value proposition. You've got to show that you've got growth potential, that it's not just something that you've been doing on the side to kind of supplement your 9-to-5 income, but it's actually a legitimate business that you've got a marketing plan, you've got a strategy, you've got a business plan, you've got it all mapped out where it's actually going to be, where it's something that you're actually going to be able to grow. And then you have the opportunity for loss of future profit. It's just that simple. As you're giving away equity, profit's leaving. And again, that's where you have to weigh out the pros and cons. Is if you can make millions, is it going to pay you out more than making hundreds of thousands? And then one of the other cons, potential conflicts as the business grows. I kind of brushed over it in the previous slide, but there are those opportunities when you start getting into equity financing that if you start to over leverage yourself, you may look up and you may have a business partner that's got 35% equity, and now you've got a equity firm that has 16% equity. That would actually mean that if the two of them agree on something and you don't, you're now the minority business owner, or you're the minority partner, meaning that you're not making as much. Your decisions can be completely bypassed by the other two. So that's something to keep in mind, is as you're looking at this, making sure that you're retaining control and making sure that you've got that you're being smart with the equity that's available. So is debt financing riskier? Now we're getting into the nitty gritty of comparing debt financing versus equity financing. So is debt financing riskier? Too much debt can be problematic. If your expenses are really high, especially as you're starting, it can put you underwater very quickly and can cause financial issues if the business fails. Again, if you're personally guaranteeing information, then it is what it is. You're going to have to pay for it. Access to funding can be restrictive in startup phases. So is equity financing riskier? You're bringing on a wealthier partner. That's not always risk. That could also be reward, but it also is a risk because they've got money. Especially if you've got one of those ideas that you would think is kind of proprietary. I can't even say it after trying. Secret. If you've got one of those industry secrets that you think is going to be able to take it to the next level, there is a potential for the business to go a different direction without you. Again, talking about equity standings and you having the information, or you having control over it. And the more equity you give up, the more influence you lose in the company. As you start bringing in, your vision starts to get diluted with other people's vision and what they'd like to see. Now, one of the things to be able to weigh out these options, and this is something that I think is really good. It helps, and you can do a quick Google search on this. It's called the financial modeling formula. And basically what you're doing is you're going to create a summary of your company's expenses and earnings in a spreadsheet. Very simple. You're going to say, okay, what's our profits? Basically, what's our profit margin look like at $100,000? What's it look like at $250,000, $500,000, $1 million, and so on, and make it where it's something that you can expand. And then you're going to use the spreadsheet to calculate the impact of future event or decision, meaning that if I take on a business loan based off of the information I have, how much of that bottom line is going to be impacted? And then how much growth can I expect from this loan? And similarly, if I do the same thing with an equity partner, if I go the equity financing route, how much increase am I going to have? And then how much loss am I going to have? And so really what you're doing is you're basically just sitting down, creating a spreadsheet going, here's how much I have to gain. Here's how much I have to lose. Does this make sense? And so from there, you're going to plug in your numbers and get a feel for which plunge, if any, that you want to take, because you may get into it and go, you know what, we can grind a little bit harder and we can bootstrap it without any financing, and which is completely an option as well. So with that, you're going to consider your equity, a financial metric of the amount of leverage that the company uses. And it uses investments and assets and the amount of equity to determine how well a company manages its debt and funds its asset requirements. So basically what you're able to do is sit down, put everything side by side, compare it, look at your numbers, and that's the biggest thing. There's a lot of factors. There's a lot of factors as you start getting into equity funding. And again, one of the things that, and this is just my opinion. I love equity. I love equity partners because there is something about bringing in somebody who's already paved the way that opens up so many connections and opportunities for you that you would never even know existed, except they've already been there. They have the connections. They've already been down this path, and they can open up a lot more opportunities, really expedite the growth. But if you may be that person who already has those connections, then debt financing may make sense. So the question is, which direction do you go? Well, if you need help with that, that's what we're here for. Give us a call at 877-600-2487. Get a free business financing assessment. And with this assessment, what we're going to do is we're going to help you. We're going to sit down, look at all the 3 C's, look at your fundability factors, figure out what financing can you qualify for right now, and what steps and what do you need to do to prepare for financing in the future. Now, look, I know some of you guys like Steve and some of you guys asking these great questions like Norman and Brilliant. You guys have been following us for a while. You got a lot of great information. So I'm going to give you the secret formula for our DIYers out there. You can actually find that at creditsuite.com/27. It's our ebook on 27 alternative ways to get financing for your business, where it's going to break down some of these. It's going to break down some of these options for you. Norman asks, I think it's a great question. How do you find right equity partners outside of going on a show like Shark Tank? Google is a great option. Kick Further is one of those places that you can go. There are websites specifically for vetting angel investors. And Norman, I think this is a great topic. Keep an eye on the channel. I'll put together some more content on this for you guys, and we'll just on digging into equity financing, how to find people. How to find investors for your business. We actually have a lot of videos that Ty's done in the past, but I think it'd be good to revisit that. So again, if you need help finding investors, you need help finding financing, figuring out your options, give us a call. Visit us at creditsuite.com just creditsuite.com. Email us at info@creditsuite.com. And guys, if you appreciated this, if you like this, feel free to share this live stream. Again, use hashtag Business Credit Toolbox to be able to get access to 5 free tools to build your business credit. And until next time, have a great day. Make sure you like and subscribe on whatever channel, and we